Hello and welcome to this session. This is Farhat, in which we will discuss an important topic in auditing, and that is management assertions. What are management assertions? What is an assertion? Well, it's a fancy word for a claim. What is a claim? You are stating, you are making a statement, you are making a claim, you are making an assertion. Who's making this assertion? Management. Management is making a claim about their financial transaction, about their account balances, and about their disclosure that are part of the financial statements. Now, these claims, these assertions, whatever the management is claiming, is telling you, they could be explicit claims or implicit claims. What do we mean by explicit or implicit? For example, an explicit claim could be something stated in the notes of the financial statement. They're explicitly stating the way they recognize revenue. They're telling you how to recognize revenue. Implicit means what? For example, when they show you a figure in an account balance, sales is 5 million. Well, that's an implicit claim that it is accurate. They're not telling you it's accurate. If they're telling you that's the number, they are giving you an accurate number. They are claiming. This is what assertions are. So simply put, management is saying, here's what we believe our transaction, account balances, and disclosures should look like. Now, assertions are based on, or they follow, the framework of the financial reporting that the company is using. For example, in the US, we use the US GAAP, and other countries, IFRS, or whatever framework you happen to be using, you will make those assertions based on that framework. Now, as auditors, you have to have a good understanding of management assertion to perform quality audit. Well, as a professional, you have to know it, and believe it or not, what you learn in this lesson about management assertion, if you're an auditor and if you're listening to me, you could relate, because when you pick up that audit program at work and you look at the objectives and the steps, they follow these assertions. That's why this topic is heavily tested on the CPA exam. Because why? Because it's a practical. As an auditor, you have to use it. So what happened from the management assertions, we're going to look at them shortly, don't worry about this. From the management claims, the auditor will write audit objectives. Objectives is what we want to do, and from the objectives we write the audit program, which are specific and general steps to achieve our goals. Now, basically what we're saying is this: as auditor, we are attesting to management assertion. What is attesting? Basically checking management assertion. Now, why assertions are essential? Like, why do we have to know them? Well, they're going to provide clarity about what areas need validation. So it's going to tell you what is important about this transaction, this balance, or this disclosure. They're going to help shape the audit objective. How are we going to approach this account? How are we going to audit this account? We need objective. It's going to help us determine the objectives of the step. And as a result, they're going to guide an evidence collection. Once you know your objectives, once you know the steps that you are dealing with, then guess what? What's left is actually collect evidence. So overall, once we collect good evidence, the whole purpose of the audit is to collect enough evidence to do what? To make an informed opinion or informed decision, making sure the financial statements are fairly stated. How do we get to that point? We look at what management claim. Okay, great. We are going to attest to those assertions. We write objectives, we write programs, we follow them, we collect evidence, and we make that claim. We testify, we attest to that assertion, to that claim. And this is what we will discuss. Now, bear in mind, in this session, we will talk about assertions. It's an important session. It's about assertions. Later on, when we look at each cycle separately, when we look at the sales cycle, the purchasing cycles, the payroll cycle, the cash cycle, we're going to be looking at these assertions again in a specific context, because when we audit cash, we have to know the assertion that deals with cash and how they apply to cash. In this session, it's an overall general session. Nevertheless, it's an important session giving you an overall idea about assertions. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
The first thing you need to know is we have 3 sets of standards when we deal with assertion, depending on the framework, whether we are following the PCAOB, the public, or the AICPA, private companies, those are the US, or International Accounting Standard, the International Accounting Standard. So we have 3 sets of standards. The bad news. The good news is this. The PCAOB and the AICPA, they are very similar. The PCAOB follow 1 set of assertions and 5 categories of management assertion. And they are similar. PCAOB, if you know this PCAOB, you'll be able to follow the AICPA or vice versa. The reason I'm saying this, because if you're taking this as an audit course in college, if you're listening to this as a student, you would see that, you know, your terms differ slightly from what's in my textbook. Don't worry, I'm going to map it at the end. But the point I'm trying to tell you, you could be looking at a different standard. And if you are an international student, which is, I know some of you are students outside the US, you will be following the International Accounting Standard. Now, the good news is there's also similarities. But the first thing you need to know, PCAOB is similar to the AICPA. And the assertion that we will be covering under the PCAOB are the existent assertion or occurrence, completeness, valuation or allocation, rights and obligation, presentation and disclosure. Now, the AICPA and the International Accounting Standard Board, those are basically the same. Basically the same. Not basically the same. And if those are basically the same and PCAOB and AICPA are similar, then guess what? Once you learn one, you can switch from one to the other real easily. Now, again, the terminology could be a little bit different. The way they group them could be a little bit different. Nevertheless, once you understand the big picture, because you're not being asked, you're not going to be asked to explain the whole framework. You're going to be asked to know what existence or occurrence is, or what's completeness, so on and so forth. So that's why you don't have to worry about the big picture. But I have to tell you, because your textbook could be only covering the PCAOB and you're saying they're not using these terms, or it's only covering the AICPA, or you could be an international student. Don't worry, they're basically all the same. Under the AICPA and the International Auditing Standard, they have classes of transaction and event, and think here anything that relate to the income statement. They have those assertions, and they have account balances. Think of the balance sheet. Now we're going to see the same thing that's going to be here. And they have 3 categories. The third category is presentation and disclosure. Now, you also might see that presentation and disclosure, not by itself, presentation and disclosure is part of account balances and part of the classes of transaction. That's fine, whether you see it as part of 1 and 2 or its own separate set of assertions. It doesn't really matter, because presentation and disclosure is relevant for classes of transaction and account balances. As I mentioned, terminology might differ a bit from your auditing textbook or course, or even your auditing course. But once you're done, you will be fine. At the end, to make it easy for you, I'm going to focus on the AICPA, then I will map the AICPA to the PCAOB, and once I map them and you could see what the AIS looks like, they're all the same. Let's focus first on AICPA assertions about transaction. And when we talk about transaction, we are making assertions about the income statement. Transaction happens in the income statement. Account balances, balance sheet. Transaction in the income statement. So what are some of the assertions that we could be making about income statement account? The first one is occurrence. What is occurrence? Occurrence is what? Recorded transaction actually did happen. Record the transaction actually did happen. So basically we're trying to ask ourselves, did the sale took place or occur? Was it an actual sale to a real customer? Were expenses actually incurred? So for example, if a company records 5 million in account receivable, they have 5 million in AR, an account receivable, well, our job as auditor need to verify to make sure that these receivables are real receivables. How do we know this? We review invoices. That's internal document. Or we can confirm that with the customer. What do we want to do? We want to confirm that occurrence did really indeed happened. And notice I said account receivable. Hold on a second. Account receivable is an asset. What's related to account receivable? I'm technically saying sales. Basically what I'm saying. But the point is, this is what I'm trying to do. I'm trying to see if this actually happened. Occurrence. 2, the second assertion is completeness. And what's completeness? Transactions that actually happen are recorded. And this is basically an implicit claim in the sense that I recorded everything that I'm supposed to record. Did the company record all sales and expense transaction? The risk is hiding expenses. It could be the risk is hiding expenses. Or for the balance sheet, the risk could be hiding liabilities, which we'll see when we look at the assertions for the account balances. Completeness is another one. Valuation, that's accuracy. What's accuracy? Accuracy is recorded transaction are stated at the correct amount. In other words, we are giving the proper dollar amount, the proper valuation to the figures. Also, that's implicit. If we're given a number, the assumption is that number is correct. That number is correct. That's the implicit assumption. Accuracy, valuation. For example, is the transaction recorded at the appropriate amount? Is it measured correctly? If the amount is $365, is it indeed $365 and not some other number other than that? For example, we could be looking at inventory or cost of goods sold to making sure that that number is correct. For example, cost of goods sold. 4, cutoff. Cutoff, sometimes it's called timing, or in some textbook they may have timing separately, but basically the cutoff. Basically what we're saying, transactions are recorded on correct dates in the correct period. Remember, in accounting, we break the life of the company into periods, artificial periods. For example, we break the year into 4 quarters, right? So if we're reporting annually, we want to make sure that everything that happened in this year is recorded in this year. Nothing is deferred revenues or expenses, and nothing is accelerated revenues and expenses. Everything that happened here is indeed belong to that year. This is what we mean by cutoff and timing. Was the transaction recorded in the proper period? No deferring or backdating of expenses and revenues. Notice I keep focusing expenses and revenues because I am dealing with assertions that deal with transactions. Classification. Classification means transactions are included in the client's journal are properly classified. What does classification mean? It means when I debited and credited the proper amount. For example, if I incurred R&D, if I have an R&D expense, I debited R&D and I credited cash or payable. I did not debit repair. If I debit repair, then the account is misclassified. This is what classification deals with. Then presentation. Presentation is important. In presentation, you will see presentation under transaction and in presentation under account balances. Transaction and event are appropriately presented and described, and related disclosure are relevant and understandable. Simply put, the notes of the financial statements, they will tell us more about our revenues. How do we come up with revenues? How do we compute the cost of goods sold? So we disclose this information through the presentation assertion. So when the company is making a claim, about an account, we have to check about a transaction claim. We have to check all these assertions about that account, check them all to make sure that that account is fairly stated before we say it's fairly stated for each transaction that we are dealing with. If we're looking at sales, we have to check sales for everything. Occurrence, did it occur? Are all sales recorded? Are all sales accurate? So let me show you what I mean by this. So if we're looking at transaction-related assertions, and for the sake of illustration, I will use sales. Here's what we'll say, basically. The audit assertion is occurrence. Well, what does that mean? It means recorded sales are for shipment made to real customer. Okay, that's the audit objective. Now, from the audit objective, what do? We need specific steps. So To make sure sales did really occur, we have to check invoices. Those are the steps. So in the audit program, we'll have a specific step about how to pull invoices, whether it's manual or computerized system, so on and so forth. Completeness. Well, all existing sales are recorded and all related disclosures are included in the financial statements. How do we check this? Well, we have to completeness for account receivable. Are they hiding anything? Are they hiding some sales? How do we know? Again, we'll have specific steps in determining whether completeness is indeed met or not. Now, how do we do this for each cycle? Sales and account receivable, we'll have this sales cycle. We'll look at steps later on, but this is the overall idea. Accuracy, recorded sales are correctly billed and recorded, and disclosures in the footnote are accurately measured and described. Now you might be saying, can we meet more than one objective in one test? Yes, sometimes as you are completing maybe occurrence, you could also verify accuracy, and we'll talk about that later on in the audit program. But the point I'm trying to show you is the big picture. You have an assertion, this is the objective, then from the objective, you have to have steps. Now in the real world, audit firms or accounting firms that do audit work, they do have the program already programmed into the system. So they'll have a bunch of questions. Some of it will be related to that company that you're auditing or not. If it's related, you check it. If it's not related, you put NA. So if the company don't have inventory, well, you're not auditing inventory, you put NA. Or if they don't have, for example, sales on consignment, and there's a question about sales on consignment, NA, the company don't have sales on consignment. The point is those program will be provided to you, but it's all based on assertions. Classification. Sales transaction are properly classified. For example, we could have sales versus rental versus consulting. Are we properly classifying the sales? Cutoff. Sales transaction are recorded in the proper period. Once again, as we're doing occurrence, we might be able to also determine this. As we're doing classification, we might also be able to determine the cutoff as we are looking at numbers. Also, as we're doing accuracy, we could also look at the shipments, shipment date, and the proper recording. And obviously, disclosure or presentation. Notes/disclosure are presentable, relevant, and understandable in simple English. So before we can say sales is fairly stated as a number, we have to do what? As auditor, attest to all these assertions. How do we attest to them? We have audit programs, specific steps. We follow those steps. And as we meet those steps, we say, good, we are good to go. So those are transaction-related assertions and specifically sales. Again, we're going to look at these assertions later on. Now let's move on to the account balances assertions, specifically about the AICPA. And here we are dealing with assets, liabilities, and equity. What are these? Balance sheet account. Now, for these, we're going to have specific type of assertions. Existence. So for assets, liabilities, we don't say occurrence, we say existence. What does that mean? Well, do the amount showing on the balance sheet, assets or liabilities, included, actually exist? Do they actually exist? Well, do the recorded assets such as building, trucks, equipment physically exist? Do the recorded liability actually exist? Well, think about it. If you want to verify whether they have a building, well, it's easy. You could just look at the building and see it physically, whether it exists or not. But that's not going to tell you whether they own it or not. Just tell you it exists. That building that they're claiming at that address, it exists. Now, if you want to know more, you want to look maybe at the closing papers. If you want to know if they really own it or not, then you want to look at their loans to see if they have any liens against it or not. But we'll talk about that. But existence is easy for assets that you can see, you can touch. Now, other assets, for example, intangibles, it could be a little bit different. About existence, the testing will be a little bit different. So the point I'm trying to make, yes, we're saying existence, we're talking about assets, but you have different type of assets. How would you verify the existence of one asset versus the other? Totally different. How do you verify the existence of cash? You confirm it with the bank. Okay. Or account receivable. We talked about account receivable. You send a confirmation to the customer to confirm whether they have it or not. Completeness. All existing balances are included. Now here the risk usually for publicly traded companies is unrecorded liabilities or heading that. So simply put, under completeness, what we are saying are all the entities' assets are accounted for, and liabilities for that matter. Usually companies try to keep liabilities out. Accuracy, valuation, and allocation. Well, balances are stated at the correct amount, and any resulting valuation or allocation adjustments are appropriately recorded and disclosed. For example, inventory. Inventory is reviewed for proper valuation. We're considering any obsolescences, anything we need to write down, or receivable are correctly stated at not realizable value. This is what accuracy is dealing with. Are the numbers correct, properly correct? Rights and obligation. The entity holds or control rights to assets, and recorded liabilities are its obligation. If we go back to that building, yes, we can see the building that they have it, they operate this building, but do they hold or control the right to that building? That's totally different. Are they renting, or is it really an asset? They do own it, right? You have to verify this. It's not only it exists, you have to verify whether they own it or not. Also, the recorded liabilities are their own obligations. Whatever liabilities they have, that's truly their liabilities. So for the building, you will check the ownership document to confirm the rights. And for liabilities, you will check the loans at the bank. You will confirm with the bank. Now, classification, well, amount included in the client listing are properly classified. They're classified in the proper place. Are assets and liability properly classified? And on the balance sheet, usually assets current and long term. Same thing with liabilities, current and long term, or non-current, which is the same thing as long term. And obviously at the end, you have to have presentation. Assets, liabilities, and equity interests are appropriately represented and described, and related disclosure are relevant and understandable in simple English. In simple English, are all assets, liabilities, and equity interests clearly described and disclosed? And the reason I emphasize in simple English, because companies like Enron disclosed everything that they were doing. They really disclosed it. They disclosed the fraud that they were committing. In other words, they told you, but it was so complicated that no one was able to kind of figure it out until after it happens. So the disclosure has to be clear, understandable, relevant. Once again, we cannot confirm an account balance is fairly stated until we test all. Now, for the sake of illustration, let's take a look at an example. Specifically, we'll deal with inventory. Inventory. Well, what do we have to do with inventory? Existence. Existence means what? All inventory recorded actually exist. Well, we need to know whether they exist or not. Now, well, this is the objective. Actually exist at the balance sheet date. What do you think a step for existence? Just use your imagination. Okay, what do you think a specific step in the audit program to confirm existence? Just send the auditor to look at the inventory, to count the inventory, to inspect the inventory, right? So here hopefully it's starting to make sense. So we have an assertion, we have an objective, and from the objective we have a step. Go check the inventory yourself. Send 2 people to go count and inspect it. Completeness. All inventory has been counted and included in the inventory balances. Maybe we want to match purchase orders to recorded inventory to make sure that everything that we purchased was included. Again, this will be the step that we will the audit program step. Accuracy, valuation, and allocation. Perpetual record, agree with item physically on hand. Inventory is written down to net realizable value. That's the objective. Well, what does that mean? It means making sure that inventory is valued using the correct accounting method. Then we have specific steps for that in the audit program. Classification, making sure, we could have many types of inventory. If we're talking about inventory, we could have raw material, work in process, and finished goods. When we're talking about manufacturing, is it classified in the proper place? Rights and obligation. Well, the company has title and no inventory is pledged as collateral. Now, you could have the inventory physically on site, but is it really your inventory? We have to review contract to make sure that you have ownership and that inventory is not goods on consignment. Somebody placed it at your place and they will take it later. You would inspect the title, and you have steps for that to confirm rights and obligation. And obviously presentation deals with notes, disclosure are presented, understandable, relevant. For example, for inventory, you would explain whether you're using FIFO, LIFO, some for FIFO, some for LIFO. You will disclose this information. So this is the account balances for the management assertion for the inventory. Once again, to claim inventory is fairly stated, you would have to test all these assertions. Again, we'll get to that inventory cycle later on. Now, if you remember at the beginning of this recording, I told you since we have AICPA standard, we have PCAOB standard and international standard, what I'm going to do, I am going to map the AICPA and the PCAOB. Now, PCAOB, they have transaction balances and related disclosure. AICPA, they have transaction related disclosure and account balances and related disclosure. It does not matter. So let's see how it works. PCAOB, for transaction balances and related disclosure, they use existence or occurrence. AICPA, they use occurrence for transaction and existing for account balances. And remember what I said, AICPA is similar to the international standard. Completeness, it's the same. They use completeness for transaction, completeness for account balances. AICPA uses accuracy, classification, and cutoff for transaction. Let's start with PCAOB. PCAOB uses valuation or allocation. For this, AICPA uses accuracy, classification, and cutoff for transaction, and for the account balances, accuracy, valuation, and allocation. Notice it's similar terminology, so don't get lost. PCAOB, for the transaction, account balances, and related disclosure, they have rights and obligation. There's no rights and obligation for transaction. There are rights and obligation for account balances, because we don't have rights and obligation for a particular transaction. And obviously, presentation and disclosure, PCAOB uses for transaction balances and obviously related disclosure, presentation and disclosure. Same thing for AICPA, presentation and disclosure for transaction, presentation and disclosure for account balances. The point is not to get nervous if the terminology a little bit different. The point is to understand the big picture and be able to answer, for example, multiple choice questions. And talking about multiple choice questions, let's take a look at this multiple choice question from farhatlectures.com. And here's the question: which of the following is an example of testing the assertion of existence? So now we're looking for existence of something. Well, let's start from the bottom. D, examining disclosure for transparency. Well, if we're examining disclosure for transparency, we're dealing with presentation. It's disclosure. It has nothing to do with existence. Out. Analyzing inventory valuation method for accuracy. Well, here they're telling us it's inventory valuation, determining the proper dollar amount, whether it's accurate or not, proper valuation. It has nothing to do with existence. If it doesn't exist, it does not matter whether the amount is right or wrong. This is not what we are testing here. So C is out. Reviewing purchase order to confirm completeness of recorded liabilities. Here we are looking for something that's not recorded for completeness. Well, it has nothing to do with existence. I'm not trying to find out whether it exists or not. I'm finding out if something is missing. Okay, so when I'm testing for existing, I'm testing for something that the company is claiming they have. So B is also an easy elimination. By process of elimination, A is the answer, but let's take a look at this. Verifying account receivable balance through customer confirmation. Well, if the company is saying we do have 5 million of account receivable with ABC company, well, you send the confirmation to ABC company and ask them to confirm, to verify, to give us evidence, external evidence, that as auditor we're comfortable with that indeed that 5 million of account receivable exist, and we're good. So what we're testing here is existence, and the correct answer is A. What should you do? You want to go to Farhat Lectures, look at additional MCQs, resources, true, false, additional exercises that I work that's going to help you whether you are an auditing student or studying for your CPA exam. This topic is extremely important. Invest in yourself, and good luck.